the Bitcoin halving, and my name is Lennox, the financial market director of OKEx, and we have three honorable guests today: Jason from Spartan Capital, Ivanish from Areno Capital, which is one of the first digital asset fund were approved by SFC, by the way, in Hong Kong. And we got KOL from Willie, which is running a really cool Bitcoin block. So I think recently Bitcoin halving is actually a very, very interesting topic to be discussed really a lot among the communities. And recently we published a lot of research, data-driven research related to these these halving events, and we think that might be a pretty good trading opportunities. So before we really access whether it's a good or trading opportunities in relation to these halving events, my very first question is to ask Jason. Do you think we found out that's based on historical data that if you buy long 3 days before the halving event actually occur and short afterwards, you will have a pretty decent return. It's occur historically and occasionally. So do you think what's the any solid fundamental reason and rationale behind this very unique pricing pattern for these kind of halving events?
Yeah, I think I have a few theories around that, but I think it's important to caveat first. I think the halving is an important event, right? In that it highlights the programmatic scarcity of something like Bitcoin, which is what gives it the characteristics that are valued in store value assets historically. But at the same time, I kind of hesitate towards kind of just isolating it as a variable. And I think Masari actually put out this chart last night about how the average return of Bitcoin over its lifetime is not really meaningfully different if you deploy, right after the two halvings on a 3 month to 1 year horizon. So it's also important to remember that the halving occurred during the longest bull market in kind of traditional risk assets. So it's hard for me to isolate that one variable and say, oh, the price did this right before halving and right after halving because of that. So for us, we tend to kind of look at the longer term impact of what it means for supply to reduce. And since the supply schedule is known, we tend to focus more on the demand side. So I think one interesting case study is, so the halving, the fact that halving could have a short-term impact on price could be because it has mimetic value, right? So we saw this in 2019 with something like Litecoin, where I think price went up about 500% in 200 days and then gave up all of the gains. Right, basically gave up 40% in the 30 to 40 days leading up to the halving before giving up more. So I think that to me suggested that people were trying to front run the halving event, and it became a self-fulfilling prophecy as more people speculated and tried to front run each other. So price actually gave out before the halving even occurred. So the fundamental case hasn't even played out there. How it's going to be different for Bitcoin, I think the demand is not going to be as transient. I think it's much more interesting setup for Bitcoin. So I was taking a look at the demand side factors leading into this halving and beyond. So looking at the retail front first, right? I think things like social media volume and search volume for halving is almost at all-time highs right now. Compared to the last peak in July 2016, we're almost 5 times as many people interested in what halving is. In terms of stable coins on exchanges, we have billions of dollars on the sidelines right now, which may or may not be deployed. And if they are deployed, I think Bitcoin is likely going to be the prime beneficiary as the most liquid pair. And on the awareness front, right, compared to the last halving, the awareness front is also a lot better in that in the last halving, 2016, Bitcoin was very much still known as, a transaction for illicit medium of transaction for kind of illicit activities on the internet. Whereas this time around, we have almost an arms race between two geopolitical powers. We have China coming up with DCEP. We have US coming up with Libra. So blockchain in that front becomes more legitimized and less stigmatized for retail investors. And even within crypto, right? If you look at things like, I think Willie tracks this on his website. There's an amazing chart on kind of the account that holds more than 1,000 units of Bitcoin. I think we've recently reached all-time high levels, and we've seen evidence in the past 6 months that miners have been accumulating significant amounts of their block rewards as well. So that to us kind of indicate that there are signs of accumulation leading into this halving. And I guess on the institution side, on the crypto fund side, I do think funds are probably less exposed as they wanted to be in the most recent price rally. So after Black Thursday, I think a lot of funds are probably underexposed right now, have been missing out on the recent price action as evidenced by the kind of depressed open interest levels on a lot of these derivatives exchanges. So I don't see a massive risk to a sudden deleveraging in the crypto market. So these are all kind of positive factors on the demand side, which I think presents a pretty good setup for Bitcoin. So long story short, I think the fundamental case for supply reduction is that it's an illustration of what makes something like Bitcoin a unique asset. But I do think the demand side fundamentals probably matter more in this case. And the demand side fundamentals leading into this halving and beyond are quite positive for Bitcoin.
Yeah, but that's kind of a very interesting theory. So even so, you're saying that even the investor or traders trying to price in the halving event or front one the halving event, the market had yet to be priced in fully of everything within the price of the Bitcoin. So because there's a really strong fundamental reasons that might be driven by miners that would like to accumulate a lot of blocks reward in response to the cut of the supply side. I think well, that's a very interesting theory. So maybe I would like to hear more opinion from Mr. Leash. So regarding, because the markets already are very two opposing viewpoints in majority into main camps. The first camp might be arguing that the event is already kind of priced in. The second believes that halving is not priced at all because we see that it will very likely that will ignite the next bull run on market cycle. So the proponents of the first cite as kind of like efficient market theories, the hypothesis, where the other one might be the supply and demand mechanics as well as comparing with the previous halving market cycle. So do you think the Bitcoin right now is as efficient as in the stock market? Or you think that supply and demand relationships in halving will benefit eventually the Bitcoin price?
Yeah, thanks, Lennox. Thanks for having me on. You know, there's a number of factors at play here. I think the market is more efficient in the sense that the information, like I agree with Jason, the information is more widely available. If I think about finance professionals in Hong Kong, I don't think any of them would have been talking or would have been aware about the halving 4 years ago, and pretty much everyone is aware of it now. So there's really a widespread understanding about Bitcoin and about the event. And I think ultimately when you have that dissemination of information, there's always going to be a bit of pre-positioning. So I definitely believe there's been buying into the event. Now, what's confused things this time is the overall risk market environment. So we've seen risk assets decline, and we've seen Bitcoin actually, you know, over time, if you test Bitcoin's correlation versus traditional finance assets, there's very little correlation, very little evidence of correlation, and that's actually one of the reasons why we advise a balanced portfolio includes a small amount of Bitcoin. But actually, what you've seen recently, Bitcoin was quite correlated to overall risk assets, and so we saw a sell-off, and we've seen the recovery, and that's been a little bit correlated with what's been happening in the overall liquidity environment. So I think as we think about where we are, you know, I wouldn't underestimate the impact that's led to. So yeah, and also on the opposing side, so you've had this swing in the Bitcoin price, and you've had a bit of a run up, I think, driven by some buying. But on the other side, I also believe there's been quite a bit of selling from small miners, in particular. Like when I talk to some of the trading desks, they've noted that there's been a bit of selling pressure from miners as, you know, they look to manage their own exposures, given their mining rewards are going to be cut in half in the next few days. So the way I think about it in terms of, like, the question is, how does this trade through the event? You know, perhaps there's a little bit of scope for a small pullback after the event. I wouldn't be surprised to see that. But if we look at the overall demand supply picture after the event, we know that there's a shortage of supply. And so if the liquidity environment is accommodative, like I believe it will be, then I actually think that the probability of the price going up in the second half of the year is more. So I would be more bullish for the second half of the year.
So you're expecting that the recent mining sell-off pressure is just very likely a short-term incident, because they're expecting the block reward will be cutting in half. They might not able to survive, so they would like to liquidate a lot of the parts. And in the longer term perspective, that especially in the second half of the year, you expect that it will be a pretty good one.
Yeah, I feel like, you know, my overall feel for the market right now is the mine is selling, plus people pre-positioning and buying ahead of this has been quite well balanced. And then the movements we've seen have been driven by, like, external factors like macroeconomy. You know, where we saw the sharp sell-off down to 4,000. Obviously, that was driven by all risk assets. You know, silver and gold had similar types of moves, you know, based on their volatility profiles.
Yeah, I think there would be interesting conversations after we come back to this, because we see a very interesting correlations after the risk off on the Black Thursday of all the risky assets. But right now, Bitcoin is so really kind of like a very strong resilience versus the other risky asset, including stock and bonds and gold. So maybe we move to the next guest, Willie. Maybe can you introduce us a little bit about yourself first?
Oh yeah, so a lot of my work has been involved with looking at what the fundamentals of the blockchain, the ledger, is giving us. So this is a new field called on-chain analysis, which I think I started in 2016 with, and it's now become kind of a staple for any market participant that wants to look at the macro sense of Bitcoin. So
yeah, we see a lot of interesting work from Willie that including on your Twitters that I check out. That's called the Willie's Bitcoin mining's energy ratio. So the ratios between the Bitcoin market cap and these correlation between their energy consumption. So I would see a very interesting insight. I love it. So could you explain to our guests that's the correlation between two parameters, Bitcoin price and the energy consumption? And do you think that the energy cost of the miners is actually the major factor in determining the Bitcoin price?
Yeah, I would qualify it, and I say it's very important what the miners are doing and the ratio between the electricity costs and the actual price, because what the miners represent is essentially what is the bottom price range, the absolute bottom we see in the Bitcoin price. The miners don't necessarily determine the top of the price wonder. It is the bottom. And so what generally happens is that when the price comes under pressure, and say we saw that when Bitcoin crashed from 6,000 to the 3,000s, that marked the end of the last bear market. You saw this effect when the weak miners went out of business, they capitulated. And in that process, as they're going out of business, they're obviously going to liquidate and sell all their Bitcoins because they're being liquidated. And what that does is a further sell pressure onto the markets that then cascades down to the next weakest miner and so forth. And you get this cascade, and it's very much like a squeeze. If you were trading, this might happen over minutes or hours as the price gets long squeezed downwards. And you get this sort of fundamental long squeezing as miners liquidate and then they dump their Bitcoin. What you're left with is the biggest, baddest, strongest, most efficient miners around, and they're the last miners standing, and they will not sell because they know everyone else has been culled out of the market, and that represents the bottom. And so every time we've seen the hash rate start to drop, we know that miners are going out of business. And then when we see the hash rate recover, we say, well, that's the worst of it over, and we're in recovery, and the miners are hodling now. And that generally, the 1,800 Bitcoins per day that's being dumped on the market by miners over the long term, over that short term, they are not dumping, they're holding because they know that's the bottom. And when we look at the energy ratio to the price, we gauge historically where we are in that kind of setting. And so whenever I see the price to the actual raw cost of electricity, really the fundamental cost of mining Bitcoin reach those bottoms, I know that it's the last strong miners left. And I know that we're approaching the bottom. So it's very, very reliable. It's one of the most reliable indicators I've seen. You can look at it in terms of hash rate ribbons, which is another indicator, but this is another view into it in actual fundamental electricity costs. So very, very reliable price indicator, when like bottom price indicator for Bitcoin.
Yeah, that makes sense because the energy consumptions actually highly determined by highly driven by the participant of the miners. So so if the hash rate is low, the energy consumption is low, you can assume that the sell-off pressure for the miners will be eased off, and you can expect a return to price. I think, yeah, I think traders can actually check out the energy ratio. That's pinpoints the very close, very interesting correlation between Bitcoin prices and the miners, because miners still, I think, kind of like a very fundamental, very important factor, at least, to the sell pressure on Bitcoin. So let's ask the guests a bit about some kind of the economic tokenomics design behind this halving. So we are thinking that halving by principle is an economical incentive to miners. So with the intention to programmatically to cut the expectation of supply. So in theory, after the exact or 32 halving event, the Bitcoin network will be sufficiently able to sustain itself solely by its transaction fees. So hence, there will be no Bitcoin or block reward is required. The transaction fees alone can sustain network alone. So do you think that halving model in Bitcoin or all the other POW consensus protocol, which is very contrary to other fiat currency, which print basically indefinitely, will be more likely by design to encourage investing rather than spending? So if this assumption is true, so Bitcoin is more like a form of digital collectible because it encourages investing, encourages storing instead of spending. Do you think Bitcoin is already right now proven to be a very good alternative investment vehicle for hashing macro event, similar with carrying similar nature with gold? Maybe we starting from Mr. Ivanish.
Yeah, sure. So, I mean, I think that the one thing we can say is it's definitely by design more suitable as a store of value than it is for you know, an exchange payments mechanism. And that's by the design of the mining and the way that the mining rewards halve. And you know, there's been a lot of work on things like stock to flow whereby you can compare it to gold and silver. And I think those analogies definitely make sense. I think if you want to compare it to those types of commodities, which is the way I certainly think about it, I think it's pretty easy to argue that it's actually a lot better. It's more portable. It's more divisible. So there's definitely benefits that Bitcoin has versus gold, for example. Where I think we need to be a little bit careful when we're comparing is the track record of Bitcoin is only, just over 10 years, 12 years. Gold's been around for thousands of years. So if you're talking about a store of value, there's a lot of trust that people have in gold, and that's based on the 4,000 years or however long people have been using gold as a store of value and as a medium of exchange. I think things happen a lot quicker nowadays. The development of science and the internet, and so yeah, I think Bitcoin can catch up very quickly, but we're still in the early stages of that. And I think there's a lot of people who need to gain that trust in Bitcoin, and once people do, then I do believe that it can challenge gold as a store of value for sure.
Yeah, interesting. So, what do you think, Jason? Hello,
Jason?
Jason's freezed. I think the question is too difficult, maybe. How about you, Willie? What do you think about whether?
I concur with Ivanish. So a lot of what he's talking about is this Lindy effect. Is like, Bitcoin's very young. It's only 10 years, 1,000 years. Gold, there's a history of people trusting it to store value in it, and this Lindy effect is like, literally, it's like, well, if all these people and throughout the ages have put money there, then herd mentality, the past will give me more confidence in the future. So then I will put money into this. And, a lot of that is like, we know that gold has been a safe haven in times of war or strife or uncertainty. Markets will rush to that. And so everyone does, because we know that behavior. And Bitcoin's only 10 years old, so we don't really have a very solid history. And Bitcoin's proving that now. Like recently, when there was what was it? There was a crisis in America where they did a missile strike into the Middle East there, where Bitcoin rallied, and it mirrored gold through that point. And that was, that's our first wartime kind of beta test of whether or not this would be a safe haven in a wartime. And right now we're testing whether or not Bitcoin is a safe haven in times of economic crash like gold is. And so a lot of this, is theoretical. We've been thinking, well, this is the right properties, but we don't know if the market responded in that way. And so we're still looking right now, is Bitcoin going to decouple from the stock market here? If the stock market goes down and Bitcoin stays strong like gold has, then yes, we will know that it is proven. And we need that proof, not theoretical. We need that history. It's only a 10-year history. So very much so. And in terms of the halvening, like you may ask, why did Satoshi decide that we need to have these halvenings? And the answer to that is that, okay, you're going to create this digital scarcity. There's only going to be 21 million coins. How do we distribute that? Because do I give it to Satoshi? Do I give it to this person we all trust? Like, how would you feel about buying into gold in a wartime scenario when Donald Trump owns all of it and you can buy from him, right? It's not very trusting. So you need a distribution of the assets so that everybody feels there's that herd mentality that you can trust in. And so one way you can do that is to bring it into existence slowly. It costs you to produce it. You're going to burn electricity, you're incentivized to sell some of it because you got to keep the lights on to keep that mining. And so it's a the best way that Satoshi figured out to get a wide distribution such that we can start to trust that there's not just one but many people, and ideally the entire world, to consider this asset as a community, a global community of investors that believe in the same thing. So that's very important, and hence we have this mining and halving.
Yeah, I think yeah, sure. I think Bitcoin do need more time to build trust because gold survive in wartime. Remember during the Second World War, that British actually shipped a lot of gold to US to preserve its national treasure. So but maybe the decoupling between Bitcoin prices and the rest of the stock market is already happening due to this COVID-19 event. So yeah, I see Jason back online. What do you think about Jason, about the digital collectibles
Yeah.
premise?
Yeah, sorry about dropping off. It's not a real webinar unless there's technical issues. Yeah, so I think you raised a good point about how there's these proof of work assets and proof of stake assets which have kind of perpetual inflation. I think it's important to remember that not all crypto assets are created to service the same purpose. So something like Bitcoin, the current narrative that is going for it is digital gold. So it is created as a form of sound money asset that is meant to be held over time. Whereas something like, for instance, Cosmos, they intentionally have a very high inflation rate, and they're not meant to be money. So a lot of these other crypto assets with perpetual inflation are actually meant to resemble other types of assets. There are things that resemble kind of equities, and they're called crypto capital. So there's many different types of different crypto assets out there. I think for Bitcoin, its uniqueness definitely comes from the fact that it has a limited supply. But at the same time, just because there's a halving, just because there's a programmatic reduction of the inflation over time, does not automatically make something a good store of value, right? I think there's more than 24 proof of work assets out there, and none of them have even a fraction of Bitcoin's liquidity, volume, or market cap. So I think what's more important for Bitcoin is actually the narrative around it. And what we've seen in the previous years is the maturation of this narrative, right? So when the white paper came out in 2008, Satoshi wrote that it's supposed to be a peer-to-peer electronic cash.
Yes.
But we've seen that kind of narrative really give way to this new digital gold narrative that institutional investors seem to be latching onto. So I guess going back to your second question earlier that you asked whether it's a good kind of hedge against macro events, I think the obvious answer is, it really depends on what type of macro event, right? I think we've maintained the view that if there's a massive liquidity crisis, liquidity crunch that impacts traditional asset classes, traditional risk assets, Bitcoin is probably not going to be spared for now, because it is still very much a risk asset for most investors. It's more like a proto store of value than a store of value right now. But whether it proves itself to be a good hedge against, say, a recession over time remains to be seen. But I guess good kind of fundamental indicators that we see on the demand side is, the growth of things like Grayscale Bitcoin Trust. It's at a significantly higher level than where it was 4 years ago. I think institutional Bitcoin is starting to enter the lexicon of kind of traditional macro investors as well, which is something we didn't see in 4 years ago. And so steps like these are important for Bitcoin to mature to be the kind of store of value or hedge investment that you mentioned.
Yeah, I think you're absolutely right. We see our institutional, even the regulatory is actually pointing to a very promising direction to legitimize and legalize Bitcoin to be something like this, to be something a really legitimate asset class. So I think maybe we will one day see a very an exploding trust from Bitcoin that's proven to be a very good hedging tools for global macro recession event. You don't see because technological change a lot here. So we have a live queue from guests. So from all guests, I think is there any risk from Bitcoin halving event? Any risk? So I'm not sure about the whether or not talking about the trading risk. But maybe everyone can share a little bit about these questions. Is there any risk in relation to Bitcoin halving? Maybe Jason.
Yeah, so I mean, there's definitely, I don't want to be facetious, but there's definitely risks with everything. I think one of the narratives that people try to peddle is that in block reward halving, you basically, the revenue for miners get cut in half in one day. So some of the more kind of least efficient miners might get kind of get priced out of business. So that could be one source of price risk in the liquidation of some of the miners that can no longer survive. So that's one of the risks that I see, and I think investors are probably pretty cognizant of risks like this because we've seen kind of put skew remain elevated on platforms like Deribit. We've seen signs of accumulation of put options as price start to climb. So I think the market is pricing in some risks as the price climbs higher. So yeah, that's one source of risk. I'm not sure if that's what the question is specifically referring to, but that's my take there.
Yeah, I think it's really maybe really related to the trading risk. You're right. We can see the option pricing on put option actually a little bit pricing a little bit more on the downside risk of Bitcoin. Now maybe we can move to the next questions to everyone. So
I'd like to jump in on that one.
Sure, no problem.
Talking about the risk is the risk. I mean, if I was to read that question in a practical sense, the risk is will number go up? And the answer to that is really on what time frame you're looking at. If you're in for a quick trade, for sure there is a very high risk. If you're looking long term, what we're saying is that the sell pressure, the long-term sell pressure, is going to halve. You know, when we say people are buying and people are selling, that's not actually true. If you look at from first principles, people are selling. Every trade is matched. There's a buyer for every seller. And so it's neutral. The only sellers in the market are people who are creating the coins out of nowhere, burning electricity, and that's new supply, and that's the only sell pressure. So the miners are the only participants that generally is accepted as a sell pressure, and that's going to halve. So if you were to look at the macro sense, when I say macro, we're talking 4-year sort of cycles. That is, there's less risk. I wouldn't say zero. The risk you're undertaking is, will Bitcoin survive? Will it collapse? Assuming that doesn't collapse and the market maintains itself, it's low risk entering after the halving because the sell pressure is halved. And then there's another misunderstanding in the market because this cycle, which is essentially our third halving, we had the 2012, the 2016, this is the new 2020 halving, and this is unlike any other halving we've had before. And that is because since I would say tail end of 2017, we had the rise of the futures exchanges. You know, our esteemed host OKEx, we have got BitMEX, we have got Bybit, we've got FTX, we've got Binance even. We've got very high volume trading in the billions of dollars per day per exchange, taking a lot of fees, right? And they are also producing a mining effect because these businesses are extracting fees, and then to stay in business, obviously you have to pay employees, and you sell that onto the market. So there's this mining sell pressure effect, which currently we're at 1,800 Bitcoins per day being mined into existence. Well, the fee market for exchanges are around, say, 1,200 Bitcoins per day. So you do the sums on that. It's like we actually have a 3,000 Bitcoin per day sell pressure, and that's going to halve. The mining's going to halve to 900. The 1,200 will still be there and may even grow bigger as more people get speculative in the market. So we're going from 3,000 to 2,100. So it's not actually a halving anymore, not like 2016 or 2012. So I don't think the halving push would be as exaggerated this time because the nuances in the market, which should not be ignored. And I think that as these futures exchanges, if the volume increases, the future halving, this may be a predominant effect. you know, lots of things can happen. Maybe the volume may not be so strong as we get stronger regulations within these derivative markets. But certainly, I do not think that you can look in the past and say that's going to happen again. A lot of people think we'll get a little dip after the halvening front running, and then we'll get this climb. You know, the interesting thing is the halvening prior was that there was no dip, but flatline, and then it hockey stick upwards. And so we forget that. And so if you look at the back trace, it's a 50-50% whether or not we get a dip in the short-term trade. So like, I wouldn't want to gamble over the short term. I would say there's very high risk in the short term. There's a lot of unknowns. The long term is a little bit more certain, but you can mute or temper that halvening of sell pressure to maybe a 1/3 drop in sell pressure is the real economics behind it.
Yeah, sure. Do you have anything to add, Mr. Anish, about the risk perspective of this halving then?
Well, I mean, the only thing I would say is, like, if you look, I guess the risk of halving is the impact on the mining community, right? The mining pools, since they're the ones who, on paper, have the most to lose. But I would look at the health of the network in terms of the hash rate and the difficulty. And I think Willie's more of an expert on this than me, but you know, it seems like the health of the network is pretty good. So yeah, I think that side of the risk is definitely mitigated right now.
But at least everyone is endorsed the short-term volatility of Bitcoin due to this halving event will be very relatively higher than post-halving or pre-halving event. So I think trader can actually capture this expected volatility anyway. There's a lot of instruments, vehicle, derivatives, option, futures for you to capture this volatility up. So maybe moving to the next question to everyone, that we're stepping into an era where quantitative easing is actually becoming infinite. And the rich world public debt is actually hitting 66 trillion from economics data, which is around 122% of GDP and global GDP by year end. So actually the textbook tells us that that's gonna be uncontrolled money printing will lead to a really big hyperinflation. And the central bank at one time had to pay off their debts by actually maybe drastically reduce their leverage or raising the tax. But we also understand that the government might have political difficulties in doing so, especially amongst those developed rich world countries. So do you think this unbridled QE will eventually lead us to hyperinflation? So that might give us more reason to buy Bitcoin? Or do you think the government somehow is able to keep the inflation in check while at the same time maintain such a huge, enormous amounts of budget deficits? Maybe we start from Mr. Anish.
Yeah, so it's staggering the amount of debt that is being created right now. I think we know of at least approaching 10 trillion of fiscal accommodation, like globally, and unlimited monetary accommodation that's been thrown at the problems that we see with coronavirus and lockdowns globally. Yeah, and I think that does have that's going to have a big impact on the environment for not just risk assets, but also store of value assets. I mean, the way I see the macro picture is, you can see in the US these fiscal stimulus policies that the US has been adopting in recent years are having less and less of an impact on the real economy. So you're seeing fiscal and monetary policy having less of an impact on productivity and having less of an impact on GDP growth. The one thing we do see, and is very clear, is those policies have an impact on asset prices. And so, we're in a world where we're struggling, and that's going to continue this year. We're struggling with very low levels of inflation, and in the case of this year, deflation. And so we're trying to combat those deflationary forces with unprecedented amounts of, monetary easing. And so, yeah, I think we're in a fight against deflation. The perceived solution to that is really excessively loose monetary policy. But my view is that the impact of that policy is only going to exacerbate the increase of asset prices. So eventually those policies will lead to inflation. But I'm more in the camp of stagflation than hyperinflation. I think when we come out of this, and it is a fight against deflation. So if these policies do get us back to like an inflationary environment, then I'm more concerned that we have inflation with limited growth than actually like runaway inflation. I think in the near term, we're going to be struggling with deflation. But deflation with rising asset prices is not good either. Especially for the majority of the population that aren't asset owners. They're seeing no increase in salaries and wages, yet it's going to be increasingly more difficult for them to buy property, for example.
Understood. So as a price, we expect to the benefits from the QE for the unlimited supply of money, but at the same time, the demand side, this could be expected to be low, and we still actually stepping nearer for stagflation or even deflation.
Yeah, so you get like low growth, and low inflation, and rising asset prices.
Yeah, pretty much happening in Hong Kong right now. So what do you think about Willie?
Yeah, I first qualify to say I'm not a macro economist, so I'm probably not qualified to speak of it. But I like to think about the first principles of it. And like we talk about inflation, deflation. Actually, there's two definitions. One is the economy, the central banks like to talk about inflation, deflation as the cost of living, the cost of goods going up and down. So you track that through the consumer price index, the price of goods. And then, but the monetary inflation, obviously, we know is like how much circulating supply is being increased, how much are we diluting the public so that the ones that are printing the money and where it goes to get that side, the hidden tax. So there's two kinds of definitions, and Evanish is talking about the price inflation and how we have to pump more money into the system, print more money to try to counteract that, because you don't want to go to a death spiral where everything's going cheaper and cheaper and the incentives get skewed. And so historically, when we print more money, you would think that, what happens is that you print money, you print lots of it. You may use that money to do what you think is the right thing, which, you use it to stimulate the core parts of the economy that are suffering that you need. You need to stimulate the like, for example, 2008, if banking collapses, then the definition of money as we know it collapsed, then all world trade fails. So you print lots of money, then you bail out the banks because you cannot weather the banks failing, because money disappears and everyone essentially fails to trade, and it's worse. So this is what's happening now, is that a lot of money is being printed, and that capital that's being printed and diluting essentially the general public. Where do we put that money? Where are we going to stimulate it? There's this other effect, is as you do this, you're putting a lot of capital, you're putting a lot more money supply into the system. And generally what happens is that that effect of that new money being dumped into the markets does not get felt to many years later. And usually what happens is, if you look back in history, is that you don't know how much to print. And if you print too much, it ricochets upwards and it hockey sticks upwards into hyperinflation, and you made a mistake and it's too late. Weimar Germany, then Zimbabwe. What's interesting to me is that a lot of these sort of studies of hyperinflation is that they were very isolated situations and in economies that are not interconnected like we are in a global economy right now. And right now, all countries are printing money. They all are doing QE. So we're all diluting at the same time. So it's a kind of an uncharted territory. And on top of that, we have this other situation is that we haven't seen this before in a realm of fiat money where we decoupled from gold, which really only fully happened in the 1970s. So we're in a situation where every country is printing money and there's nothing to back it. You can print it to infinity. And we're at the height of a global interconnected economy. And that tells me one thing, which is I don't know what's going to happen, and I think that to say, will we go into hyperinflation is too simplistic a question. And I think the second order effects of how this all plays out into the system will be much more interesting and much more important. And you can get totally wrecked thinking one fundamental thing will happen. And the second order effects that happen in the short term will kill you in where you allocate your assets. So my answer to this is it's complex. I'm not qualified to understand this, but I know that no one's seen this before, and I think everyone's guessing. Did we lose our host?
We've lost Lennox.
I think we might have lost the host, yeah.
No, I could speak to this in 2008 with the banking collapse. I remember being, okay, the banks are screwed. I'm going to short banks. And what's going to happen when the banks go under is that gold will be a safe haven. So I'm going to long gold. What was interesting to me was that it was like the second order effect is that as the banking started to destabilize, everyone got scared.
Sorry, yeah, we got some technical issue here too. So,
yeah, right. Let me just finish. Is that everyone?
So maybe Jason can actually share your viewpoints about the same question as well.
Yeah, I'm curious to hear what Willie had to say about the 2008.
Yeah. I was talking in the importance of second order effects, right? I was long gold and short banks and leading up to 2008 crisis because that makes sense, right? But like the second order effect was, oh no, the banking is destabilized. That means our entire economy is destabilized. So what does everyone do? They exit all of their trades. If they're short, they're long, it doesn't matter. You get out of that margin trade, and all the traders ran to cash. So cash hockey sticked upwards. US dollar went super strong, and gold dropped against the US dollar, even though that was the long-term correct view. So if you were long gold like I was, that was a bad trade because that second order effect was not taken into account, even though long-term fundamentally it was correct. Gold went on a unprecedented in recent decades bull run right out to 2012. And shorting the banks obviously was right, but not to take into effect these sort of second order, this, then that, and then that, and then that kind of thing, it would be a mistake. And I see the same with this sort of idea around, we're going to hyperinflate, what do I buy because we're going to hyperinflate? Because a lot of things will transpire before this comes to pass.
Yeah, I think I definitely agree with that take. And just a disclaimer, I'm not a macro guy, right? So I'm definitely not qualified to commentate on this. But I would comment on what I see in crypto. I think people in crypto tend to have some people in crypto tend to have a pretty simplistic view of money printing and hyperinflation. They kind of think that once QE happens, we're going to see a sudden implosion of the dollar. Money's going to not mean anything. But as Willie pointed out, right, in 2008, many people peddled the same narratives back then. They were saying we're going to see hyperinflation in U.S. after QE, but inflation has consistently undershot expectations, and CPI remained low. And I think that's because people have this kind of reductive view of what money printing actually is. And we all studied money multiplier in economics, right? So the only way for the monetary base to flow in the economy is if it translates into M1, into real money, for banks to increase lending commensurately. And I'm not sure that's happening immediately. I don't think it's my edge to kind of predict when hyperinflation may or may not happen. But so I think I always default back to the demand side fundamentals, right? What's the evidence telling us? And the evidence is saying that there is a lot of demand for stable coins recently, especially in kind of like Asian OTC desks. And I think the aggregate market cap of all stable coins, USD denominated stable coins, has reached $9 billion. So that signals to a certain extent, the wider demand for dollars that we're seeing. Now, as to whether that's going to be deployed into Bitcoin, into crypto, I think that's another question. But it presents a pretty nice setup in that you have $9 billion, you have billions of dollars of stable coins on exchanges. You have all of these demand side factors that I mentioned towards the beginning of this panel. And we have this kind of narrative around the halving also happening at the same time. So I think it presents a pretty good entry point for crypto. But as to whether hyperinflation will be the immediate catalyst for the adoption of Bitcoin, I personally don't think so. I don't think it's going to happen. Even if it happens, it's not going to be a thing that happens, next week or next month. Yeah, so that's just kind of my take there.
Yeah, interesting. So we think the stable coin, the recent market cap stable coin is actually due to the fact that U.S. cut its interest rate to 0.
I don't know if it's due to that one variable. It could be from people selling off some of their crypto asset holdings to stablecoins and holding on an exchange. It could be people trying to gain easy access to USD in places where gaining access to USD might be difficult. It's hard to say. But there's this actually great article that came out a while ago about kind of crypto dollars, about how this increase in demand for USD might translate to increase in demand for stable coins, which might in turn lead to demand for Bitcoin. So I think that's one interesting kind of thought experiment and path to think about. But we're a bit early in the process. I wouldn't say that all of the growth in stable coins is from people trying to gain access to dollars from emerging countries where, like Lebanon, where currencies are being debased. But there might be an element of that, and that element might become bigger over time.
Right. So thank you, Jake. So maybe we are running out of time. Sorry, maybe actually overrun, right? A lot. So maybe one very final question for everyone. So what do you think about the Bitcoin price by the end of the year?
What was that? I didn't quite get that. What do I think about?
What do you think the Bitcoin price by the end?
By the end of the week, the end of the year?
Year.
End of the year, okay.
Anyone?
No one wants to take
this is the classic number go up.
Investment
Number go up.
Tell me what the price will be at December 31st, 11:59 p.m. please.
$1 million.
I hope that paints a picture. Is there anyone that's a perfect oracle? And so when you can paint fundamental pictures, you can get a really gray zone of what is probable, and then you superimpose on top of fundamentals what the strategic position traders are when they can do they do the largest volume. They get to move the price in a very noisy pattern. So if you want a price point at that date, it becomes very difficult because you may be destroyed through a trading long squeeze, short squeeze that, like if I was to say last year where the price should have been, it should not have been 14,000 where it ran up. And that was a series of trader orchestrated short squeezes. So I could say fundamentally what maybe it should be probabilistically But what the price actually will be is just anyone's gamble, and I would not want to be looking at the dollar price for your livelihood. So there's a lot of models you can look at. Realized price, which is what the actual average person, or the entire, not average, but everybody paid on average for their coins, and so these models are much more smooth. And you know, right now I don't see us hockey sticking to anything like we saw in 2017, and I do think that we're quite sideways bound for a while. I don't think we'll break all-time highs before the end of this year. I think we've got a lot of sideways movement and consolidating to do, because we've come from a place where we punched to 14,000 way too early. We're consolidating. We're weathering COVID. So I don't think we're going to break all-time highs by the end of this year. So I would say probabilistically, we're going to be above the mining floor, which I would guess by the end of this year is more than $7,000, maybe even 8,000. And I think that we're not going to break all-time highs, which is 20,000. And I think one of the key price points is a monthly close above 14,000. And I'm not sure we'll necessarily do that, but that's the range. And to me, that's like a practical view. Like if you want any more accurate, then you're going into the realm of total gambling.
Okay, now it sounds like we got the range already. Anyway, thank you so much for you guys. It's really interesting discussion, and I'm hoping that we can do a lot more of it in the future. Thank you guys for this.
Thanks, guys.
Thank you, everyone.
Thank you. We'll catch you guys later.
All right, catch you later.